While the world obsesses over Bitcoin and tech stocks, something far more significant just happened in a market most people completely ignore. Silver hit $94 per ounce on January 17, 2026, a staggering 209% year-over-year gain. But here's what makes this different from every other commodity rally you've ever seen. This isn't being driven by speculators or hedge funds. This is being driven by physics, by the fundamental reality that every piece of technology defining our future, artificial intelligence, electric vehicles, solar energy, quantum computing, requires massive amounts of a metal that's running out. And when I say running out, I don't mean in some distant theoretical future, I mean right now. The US Mint just halted production of silver eagles due to supply shortages. Physical premiums in Asia are hitting $110 to $130 per ounce. That's $30 to $40 above the paper spot price just to get your hands on actual metal. And according to supply-demand projections I'm about to show you, we haven't even begun to see how high this goes. Analysts are now forecasting overshoots to $120, possibly $150 per ounce before any stabilization occurs. Because what's happening isn't a bubble. It's a structural supply crisis meeting exponential technological demand. And if you don't understand the math behind this, you're about to miss the investment opportunity of the decade. Welcome back to the channel. If you're new here, hit that subscribe button and notification bell right now, because this is the kind of analysis that gets buried by mainstream financial media who are too busy talking about stocks that make them advertising revenue. Now, let's break down why the industrial demand story for silver has completely shattered every previous market assumption, and why this rally is just beginning. To understand the magnitude of what's happening, you need to see the numbers, and I'm going to give you the real data. The math that Wall Street doesn't want retail investors to understand, because once you see it, you can't unsee it. Global silver mine production in 2025 was approximately 835 million ounces. That sounds like a lot, until you look at demand. Total silver demand in 2025 hit 1.21 billion ounces. Let me repeat that. 1.21 billion ounces of demand against 835 million ounces of supply. That's a deficit of 375 million ounces in a single year, the largest supply deficit in recorded history for this metal. And here's the terrifying part. That deficit is accelerating. Let me break down where this demand is coming from, because this is where the story gets absolutely wild. Solar panel production consumed 161 million ounces of silver in 2025, up from 140 million in 2024. Every solar panel requires approximately 20 grams of silver for the photovoltaic cells. Governments worldwide have mandated massive solar expansion. The EU's ARE Power EU initiative targets 600 gigawatts of solar by 2030. The US Inflation Reduction Act subsidizes 950 gigawatts by 2035. China is building 1,200 gigawatts by 2030. Do the math. Each gigawatt requires approximately 1 million ounces of silver. We're talking about demand increasing to 250 million ounces annually just for solar by 2028. That's 30% of current global production consumed by one technology sector. Electric vehicles used 88 million ounces in 2025. Every EV requires between 25 to 50 grams of silver in various components: battery contacts, circuit boards, charging infrastructure. Tesla alone produced 2.1 million vehicles in 2025. BYD produced 3.6 million. Volkswagen, GM, Hyundai, Ford, the entire industry produced over 18 million EVs last year. And global EV sales are projected to hit 40 million units by 2030. That's 110 to 140 million ounces of annual silver demand just for vehicles. And that doesn't even include the charging infrastructure, which requires an additional 30 to 40 million ounces. But here's where it gets truly insane. Artificial intelligence, infrastructure. This is the demand catalyst that blindsided every analyst, every forecaster, every traditional commodity investor. Because nobody in 2023 predicted the scale of AI build-out we're seeing right now. A single AI server contains approximately 1 to 1.5 kilograms of silver in various components: advanced semiconductors, high-frequency circuit boards, thermal management systems, Power distribution units. Microsoft announced in late 2025 they're building 22 new AI data centers by 2027. Google is building 15. Amazon Web Services is building 18. Meta is building 12. And those are just the US tech giants. Alibaba, Tencent, Baidu in China, they're building another 30 facilities. Each data center contains between 50,000 to 100,000 servers. Let me do the math for you. 100 data centers times 75,000 servers average times 1.2 kilograms per server equals 9 million kilograms of silver. That's 289 million troy ounces from AI infrastructure alone in the next 36 months. And it doesn't stop there. Samsung just announced in December 2025 their breakthrough solid-state battery technology for EVs, which uses silver-based contact materials to achieve faster charging and higher energy density. They're projecting production of 5 million units by 2028. LG Energy Solutions immediately followed with their own competing technology. CATL in China announced a similar development. These batteries require 60% more silver per unit than traditional lithium-ion cells. When you add it all together, EVs, AI, consumer electronics, medical devices, 5G infrastructure, military applications, industrial silver demand is projected to hit 675 million ounces by 2027. That's 81% of current annual mine production consumed just by industrial applications, before you even account for investment demand, jewelry, or silverware. Now here's the question nobody in the mainstream wants to ask. Where is this silver going to come from? Global mine production has been essentially flat since 2016. Hovering between 820 and 850 million ounces annually. There are no major new silver discoveries. The largest silver-producing mines, Cannington in Australia, Fresnillo in Mexico, Saucito in Mexico, Penasquito in Mexico, Antamina in Peru. These are mature operations with declining ore grades. It takes 10 to 15 years to bring a new mine from discovery to production. Even if we discovered a world-class silver deposit tomorrow, it wouldn't produce a single ounce until the mid-2030s. Recycling provided about 180 million ounces in 2025, but recycling rates are already near maximum efficiency. You can't recycle silver from a solar panel that's designed to last 25 years. You can't recycle silver from an EV battery that won't be scrapped for 15 years. That silver is locked up in infrastructure for decades. Ground inventories are evaporating. The COMEX reported commercial silver stocks of 243 million ounces as of January 2026, down from 267 million just 3 months ago. That's less than 3 months of global industrial demand. The U.S. Mint announced on January 12 they're halting production of American Silver Eagles indefinitely due to inability to source sufficient blanks from their suppliers. This is the first time in the modern era that the U.S. Mint has completely stopped silver coin production due to supply constraints, and the most revealing data point of all, physical premiums in Asian markets. In Shanghai, physical silver is trading at $110 to $130 per ounce, while the COMEX paper price shows $1.94. That's a $16 to $36 premium, 17% to 38% above spot just to get actual metal delivered. When physical premiums diverge that dramatically from paper prices, it's telling you that the paper market is a lie. The real price of silver, the price at which actual metal changes hands in the physical world, is already well above $100. On Reddit, particularly r Wall Street Zilla and r Silverbug, investors are documenting this in real posts show coin dealers completely sold out. Wait times for common bullion products extending into April and May. Premiums on silver. Eagles at $14 to $18 over spot in the US market. People are waking up to what's happening, and the scramble for physical metal has already begun. This is exactly what happened in 2011, except the fundamentals now are exponentially stronger. In 2011, silver went from $18 to $49 in 6 months on investment demand and QE fears alone. Industrial demand was steady and predictable. Now we have industrial demand that's literally exploding, growing at 12% to 15% annually combined with supply that can't respond. This isn't comparable to 2011. This is unprecedented. And here's why silver has the edge over gold in this environment. Something the X posts and Facebook discussions are highlighting. Gold is primarily a monetary metal. Yes, it has industrial applications, but 90% of gold demand is investment and jewelry. Silver is both monetary and industrial. It's the only metal that serves dual purposes as a wealth preservation asset and as an irreplaceable input for technology. You can't build the green energy future without silver. You can't scale AI without silver. You can't electrify transportation without silver. Gold is beautiful and valuable, but the world could function without it. The world cannot achieve its stated technological and environmental goals without massive amounts of silver. So where does the price go from here? Conservative supply-demand modeling suggests we're heading for $120 per ounce by mid-2026, as industrial buyers scramble to secure multi-year supply contracts. More aggressive forecasts accounting for potential investment demand if retail and institutional money starts flowing into the sector suggests overshoots to $140 or even $150 before any stabilization occurs. And stabilization is a generous term, because stabilization requires either demand destruction or supply response, and neither is likely. Demand destruction would mean shutting down solar factories, halting EV production, abandoning AI build-out politically and economically impossible. Supply response would require new mines, which can't materialize for a decade. The only real stabilization mechanism is price rationing. Silver gets so expensive that manufacturers desperately seek substitutes or reduce usage, but for many applications, there is no substitute. Silver has the highest electrical and thermal conductivity of any element. You can't replace physics. You can engineer around it to some degree, thinner coatings, more efficient designs, but you can't eliminate the requirement entirely. Now, let me talk about how to position for this, because knowledge without action is worthless. Physical silver is the foundation. Coins and bars from reputable mints, American Eagles, Canadian Maple Leafs, Austrian Philharmonics, or generic bars from PAMP, Sunshine Mint, or Asahi. If you can find them at reasonable premiums, buy them, but recognize that physical has limitations. High premiums right now, storage considerations, liquidity constraints when you want to sell. For most people, a core position of 10% to 20% of your precious metals allocation in physical is appropriate. For those wanting more exposure or unable to access physical at reasonable prices, silver ETFs are an option. SLV is the largest, with $14 billion in assets, but I'm skeptical of any fund that doesn't allow retail redemption for physical metal. PSL Visprat Physical Silver Trust is structured better, allows institutional investors to redeem for physical, and stores metal in segregated, audited vaults in Canada. CEF, Central Fund of Canada, holds both gold and silver in allocated storage, but here's where it gets really interesting for aggressive investors: silver mining stocks and royalty companies. When silver moves from $94 to $120, that's a 28% gain. But a silver miner with $70 per ounce production costs sees their profit margin go from $24 to $50 per ounce, 108% increase in profitability. That leverage is why mining stocks can outperform the metal 3 to 1 or 5 to 1 during bull markets. First Majestic Silver, Hecla Mining, Pan American Silver, Core Mining, these are primary silver producers. When silver rallies, they benefit directly. Wheaton Precious Metals and Franco-Nevada are royalty companies that finance mining projects in exchange for percentage of future production at fixed prices. They have massive operational leverage without the mining risk. The green energy angle is particularly compelling. Companies positioned at the intersection of silver mining and renewable energy supply chains could see extraordinary investor interest as ESG funds and clean energy ETFs start recognizing the critical role of silver. Imagine a mining company that can market itself as the essential enabler of solar energy transition. That narrative alone could drive a valuation premium. But this is critical. Mining stocks are volatile and risky. Mines flood, strikes happen, governments change tax laws, or grades disappoint. You need to do due diligence, diversify across multiple companies, and never put money into mining stocks that you can't afford to lose entirely. This is speculative, high-risk, high-reward territory. There's also the futures market for sophisticated traders, but unless you fully understand contango, backwardation, margin requirements, and delivery mechanisms, stay away. The futures market is where retail investors get absolutely destroyed by professionals. For most people, the strategy should be core position in physical metal that you hold long-term regardless of price fluctuations. Supplemental position in PSLV or similar allocated storage ETF for liquidity and easier trading. And if you're aggressive and can tolerate volatility, a smaller speculative position in quality mining stocks. The key is to position before the broader market realizes what's happening. Right now, silver is still viewed as a boring commodity by most investors. It doesn't have the sexy narrative of crypto or AI stocks. But when industrial buyers start panicking about supply, when more mints halt production, when physical premiums hit $50 over spot, when CNBC finally runs a segment titled "The Silver Crisis," by then, you'll have missed the best entry prices. This is a multi-year trend, not a trade. The supply-demand imbalance doesn't resolve in months. This plays out through 2027, 2028, possibly into the 2030s, depending on how aggressively the world pursues electrification and AI development. Look, I know some of you are thinking, this sounds too good to be true. If the supply-demand is so obvious, why isn't silver at $200 already? Fair question. The answer is that markets are inefficient, information flows slowly, and most investors are chasing whatever CNBC tells them to chase. The silver market is also heavily manipulated through paper contracts. But that manipulation only works until physical demand overwhelms the system. And we're watching that happen in real time with these Asian premiums and mint shortages. The other pushback I hear: what if they find a substitute? Sure, that's possible. But after 5,000 years of human metallurgy, we haven't found anything better than silver for electrical conductivity. And even if a substitute emerged tomorrow, it would take years to redesign products, retool factories, and scale production. The silver demand spike is happening now. So here's my challenge to you. Go verify everything I've said. Look up the COMEX inventory data. Check the Silver Institute's supply-demand reports. Read the US Mint announcement about halting coin production. Look at Asian premium data on Kitco or Bullion. Search Reddit for posts from coin dealers showing their empty inventories. Don't take my word for it. Verify, because the beautiful thing about truth is it doesn't require belief, just requires observation. Silver hit $94 on January 17, 2026, a 209% year-over-year gain driven by industrial demand that's breaking the market. The question isn't whether it goes higher. The question is, will you be positioned when it does? This channel exists to give you information that challenges the mainstream narrative, that empowers you to make your own decisions instead of following the herd. If you found value here, subscribe, smash that like button, and drop a comment. Are you buying physical? Investing in miners? Skeptical of the whole thesis? I want to hear from you. The greatest investment opportunities come from recognizing structural shifts before the crowd. The AI revolution, the green energy transition, the electrification of everything. These aren't theoretical future events. They're happening right now, and they all require massive amounts of a metal and structural deficit. Position accordingly. Stay informed. Stay ahead. I'll see you in the next one.